And listen here, because this is very dangerous and I want you to understand this, okay? You don't want to miss this, all right? One person sells off, market goes down, people get worried, more people get worried, people start to sell off, more sell off, more sell off, more sell off, and then you have like this massive problem. Hey guys, TommyBryson here, and welcome back to the channel. And by the way, you ever heard that song by Lady Gaga that says, "I'm on the edge of glory, and I'm hanging on to a moment with you"? Now, I'm not a singer, I never promised you that, but the point is that the moment is the stock market, and we are all hanging on. And if we make it, we're gonna have this massive moment of glory. And it's easy to believe the story, you know, when you're not in it, because we all know the stock market is 100%. It has recovered from every single recession, downturn, everything. It is 100% guarantee so far based on history that it has recovered over and over again. And when I tell you that, it seems very believable. We all believe it, right? But then when you're down 10%, you're kind of like, okay, yeah, we know this is gonna recover, everything's fine. When you're down 20%, you're more like, yo, Tommy, what's going on here? Like 20% is kind of big. When you're down 30, 40%, you start to rethink history entirely. You're just like, maybe history wasn't right. You know, maybe that 100% ratio isn't all the way there. Maybe I'm gonna get screwed over, okay? Everyone gets worried, so don't worry about it. That's my point here. And in this video, my goal is simple. I'm gonna tell you exactly what's going on, because once you understand what's going on, you'll have more confidence to do what you need to do to actually invest money and take advantage of everything going on. Although things might get even worse, okay? But once you understand what's going on, you're not gonna go too crazy. And then second, I'm gonna tell you exactly how much money you should be investing to take advantage of everything going on right now, okay? Because by the way, it is very rare to see these many downturns happen, for example, in less than 5 years. In less than 5 years, we had around like almost 3. So that's awesome, because it means we have a lot more opportunities to buy the dip, to buy the massive discounts, and make a lot more money long term. But it's tricky if you don't understand what's going on. Now, before I get started, do me a favor, smash the like button. If you're new here, join the family, subscribe to the channel, and hit the bell so you get notified, so you don't miss out on any videos about money and notifications and all that good stuff, okay? But overall, let's start at the beginning. So the very first thing, guys, I gotta explain this, is basically what we just saw like happening from 2021 to like early 2022 now was, in my opinion, kind of like an artificial bull market, right? Market is up, everything's great, but it's kind of artificial, you know, because we injected a bunch of money into the economy. And when I say we, I mean the Fed. I don't work for them, but it's we as a nation, so we all decide together. Not really, no one asked me, okay? But the point is, we injected a bunch of money into the economy when the economy was closed to kind of prevent it from actually going down into a recession and eventually maybe a depression, all right? That's what happened there. To me, that's artificial, because that money, it came out of nowhere. They printed it, okay? That's what happened. Now, picture this, common sense, no Fed, no tricky words here, just common sense. If you're buying a business for $50, and that is its value, its intrinsic value, what it's actually worth, and all of a sudden you have printed money, people will get really excited, it's cheap to borrow money, people invest a bunch of money into this company, but guess what? This business has not changed. It doesn't have more customers, it doesn't have a better business model, it doesn't have new management, it hasn't become more efficient, but all of a sudden people are investing more and more and more and more money into this entire business, and it goes from $50 per share all the way up to $100 per share. And that's the danger of a bull market, because eventually the stock market will adjust. And it will adjust, the prediction is, right? And that's what we all believe, value investors, is that it will adjust based on intrinsic value. So it will return back to what it's actually worth, which in this case is $50 per share. Eventually, it will go down there. However, it's kind of like whenever you go to your grandma's house and she's like, oh my gosh, you're so cute, you're so pretty, you must have all the girls after you, and your ego gets a little balloon, your chest kind of puffs up, and you're like, I am good looking, right? And then you leave your grandma's house, you're on the streets, no one looks at you, no one cares, okay? Because you get a little attitude adjustment. That's what happens in the stock market. Everyone gets excited, but then, you know, we all get an attitude adjustment. That's how the game works, okay? So overall, here's the big problem here. And listen here, because this is very dangerous, and I want you to understand this, okay? You don't want to miss this, all right? Here's the problem. If this company is worth $50 per share, and it was up, for example, to $100 per share. If the stock market falls by 25%, the company is still at, for example, $75. So if you don't understand how to value an individual company or an individual stock, you might assume that just because it's down 25%, you're going to be buying the dip, but it's still expensive relative to what the value actually is. So that's where things get foggy. For individual stock pickers, people that are picking individual companies, you can't base it that the price went down, so I must be getting a big discount. It doesn't work like that. You only can kind of tell with common sense when the fall is very drastic. Kind of like when the airlines went down like almost like 60%. Like that was pretty crazy, like pretty obvious. But for the most part, it's very hard to tell. Almost impossible. And if you do try to do it like that, you're basically just guessing. And when you involve guessing and investing, you get gambling. And whenever you get gambling, you lose your money. Usually, the odds are not in your favor. So here's my second point. Okay, what's causing all this fuss? What's causing all of this drama? Why is everyone so, on edge, like Lady Gaga says, right? And why is the stock market going down? Well, there are three main reasons. First of all, the Fed did hike up rates. So the rates went up. But then there's the worry that, what if they raise it up again? And here's why this is something to get worried about. Because usually when that happens, the stock market goes down, the economy slows down, and here's why. Little basic, elementary level understanding of this stuff, okay? The understanding is that if the Fed raises rates, it becomes more expensive for banks to borrow money. Then businesses, obviously, becomes more expensive for them to basically borrow money. Prices go up. On top of that, they're not basically borrowing a lot more money because it's more expensive, not hiring that many people. And then us, the consumers, we're not borrowing that much money either because in reality, it's kind of expensive, okay? Things start to slow down. The economy starts to slow down. Prices start to fall. That's the idea in a sense, like as far as like the stock market, okay? And you might say, Tommy, well, that's terrible. Why not keep the rates low forever? Because when the rate goes low forever and it's very cheap to borrow money, inflation starts to go crazy. So by raising rates, you slow down the economy, but you also help in a way stop or slow down inflation. And by the way, inflation is a man-created economic thing. So they can control it by doing all these little switches of ups and downs. But that's what people are so scared. Because if they raise rates again, it might fall, might get even worse. And everyone is on edge because of that. Second, you also have, for example, the tech industry, okay, or the tech market. It's been down for the past 4 months, okay? Now, whenever you have the market is down for 1 week, you kind of understand it. 2 weeks, 4 weeks now? 2 months? 3 months? Well, 4 months? According to Forbes, it's been down for around 4 months. Now, what happens is people get very angsty. And 4 months in this very goldfish mentality that we live in the society, it's kind of like the belief to say, well, that's going to go on forever now. It's never going to recover. So that actually contributes to the market going even lower and lower and lower. And then lastly, at the end, which is also very important, is that you have also a massive sell-off. Now, common sense says, by the way, I want to clarify this, and I don't want to offend anybody here, but it's very true. Common sense and human nature are not together. They don't go along. Common sense, human nature doesn't go together. Common sense is not common whatsoever. So common sense says, to make money in the stock market, you want to buy low, you want to sell high. Common sense, okay? That's what happens there. However, though, when the market is high, people get greedy. They want to buy more. They want to make money. When the market is down, people get very scared. People get very worried, and people start to sell things off. Now, this causes a big catalyst, or I should say in a more simple term, this causes like a big stampede in a sense. Like Simba, when the dad passed away or whatever, it's the same thing. One person sells off, market goes down, people get worried, more people get worried, people start to sell off, more sell off, more sell off, more sell off, and then you have like this massive problem, and you run into a massive correction. And then the big thing is when the market now is selling for below than its worth. So now remember that business I told you about that was going for $50 per share because that's its value? Well, imagine if it goes down to $25 per share, but the business still has the same customers, same efficiency, same structure, same management. So it's still a solid business, the same exact one, but now it's gone down to $25 per share. So that's when we want to go ahead and we want to buy a lot. That's the definition of buying the dip, when you're buying at that price. But to kind of clear everything up, it's kind of like all those three things right there plus more, they're all causing the sell-off. The Fed might raise their rates. Oh my gosh, this type of market over here, tech market, is basically down. All these things that people worried. But common sense says when the market is down, that's when you want to take advantage. But it's hard to do that when you have, for example, your retirement fund on the edge and you're worried that it's down 25%. It might get worse tomorrow. Well, what do I do? Let me just sell off and cut my losses right now. It gets worrisome. Even knowing the answer and still doing whatever is required is very hard to do. So I don't blame anyone whatsoever. Now, the last part of this video that I gotta explain here is, well, how much money should I invest into the stock market right now? And you know, I gotta be honest with you, I am itchy right now. Right now, I'm itchy. I wanna sell my wife. I wanna sell my kids. I wanna sell my dog. And I don't have any of these things, okay? At all. But if I can borrow money against these things I don't even have right now, I would do it to just invest all that money into the stock market. Obviously, I'm joking. I don't do the whole leverage thing where you borrow money to put into the stock market. That's not what I do, okay? But the whole point is that it gets you very excited when you understand what's going on. Right now, I'm negative. Like, I'm down a lot of money. Not relative to what I bought. I'm still like up, like relative or whatever. But I'm down. There's a massive correction, okay? So I want to go ahead and take advantage of it. But, you know, here's the thing. You got to understand that although this is rare, to have this many down markets like in less than 5 years, which is an amazing thing for us, and it's going to mean, for example, greater returns in the long term, but it's still the long term. If you are investing the way I invest, which is basically into boring stuff like ETFs and index funds, and if you want to do mutual funds, great for you. I don't do mutual funds though. The answer is though, right? That whatever money you set aside today and you're going to be buying at a discount, you're not really going to see that much return until 10, 20, 30 years into the future. So my big thing is that right now, I'm only investing 20% of my income. That's it. Because I have a project I'm putting money into right now, and I can't put all my money into the stock market and then fall short on my project, then have to sell money, have to borrow money, because that's not great business sense whatsoever. So my advice would be this, okay? I'm still gonna do 20% no matter what. Rain, shine, whatever. But if you have, for example, everything taken care of, as far as, for example, I have no consumer debt, I have a fully funded emergency account, I'm up into retirement, and I also have a paid off home, and you wanna go ahead and triple down onto the stock market and invest a lot more money, that's a good idea. But just remember that whatever money you're investing today, you're not really going to see this big massive return until 10, 20 years into the future. This is basically if you're basically going ahead and investing into ETFs, index funds, because the goal is you're buying when the market is down a lot of money, but for the most part, you're averaging out. So you're basically dollar cost averaging, but then in the long term, it's going to be a big return. However, if you are the type of person that's investing, for example, into individual stocks and so on, like AT&T. I saw a comment yesterday. This guy said, I'm investing into AT&T. I want to put more money in, but I'm worried because it might go down even further. And then he's like, oh, but it's AT&T. It has to go up back, right? And I'm like, no, it doesn't have to go back up at all. You know, a lot of companies, they go bankrupt. They go bad. They go sour. So you can't just judge it based on prices down. It's AT&T or Netflix, so it got to go up eventually. Doesn't make sense. You got to understand how to value a company. And if you don't know how to do that, well, you're going to find yourself in big trouble. So that's my advice there for individual stock pickers. Don't worry, I'm not leaving. I'm just showing you this book right here. If you want to learn how to value investments, this right here is a great book, okay? It's how to value investments, and it teaches you like the basics, but then you have to keep reading more, and it's a long-term job, okay? So long-term job, you work every day at it, okay? But that's it, guys, for this video. Thanks for watching. As always, hopefully this video gave you some calm before the storm, and you kind of relaxed now. And if you have some extra money, you're going to invest it, which is great. But if you don't have the money, just take it easy. And I'll tell you something, because you got all the way to the end of this video, and here's what it is. Right now, I'm just doing 20% to the stock market, because aside from this project I'm doing, I also want to set some money aside to buy like 2-3 properties and make some passive cash flow, physical income from real estate. So that way, like, I never have to worry about interrupting my investments. Because if you have $2,000, $3,000 coming in from the real estate market, and you have like 3-5 units, which is very unlikely that all of them are going to stop paying you, then you kind of have to like worry a lot less, right? Because you have that income to cover all of your expenses, and to me, that's awesome. So I want to diversify just to make sure, you know, I'm a very diversification type of guy. But thanks for watching, guys. Like, subscribe, hit the bell so you're notified. Comment down below any questions. If you want to DM me about something, DM me on Instagram at TommyBryson. And that's it. Thanks for watching. Long-term team officially out. More content. My face is here. Click it, subscribe. And as always, long-term team out.